Welcome to Fiscal Voyage. I'm Felix. And if this is your first time visiting my channel, make sure to hit the subscribe button because I'm doing a series of covering different companies that are under the Dividend Aristocrats. The Dividend Aristocrats are companies that have been growing dividends for over 25 consecutive years or more. So in this video, we're going to talk about one particular Dividend Aristocrat called McDonald's. And McDonald's has been growing dividends for 44 consecutive years. And make sure to watch towards the end of the video because I'm going to provide you with a fair value price and a recommendation either to determine if the company is a buy, hold, or sell.
Okay, McDonald's Corporation, ticker symbol MCD. I'm sure you guys heard of McDonald's or shopped and bought their burgers and seen a McDonald's store. They're nationwide and worldwide. The company is a world's largest restaurant chain by revenue, serving over 69 million customers daily in over 100 countries across 37,000 outlets as of 2018. It's known, of course, for its hamburgers, cheeseburger, and French fries, and other chicken products. So if we look at the fundamentals from the company, revenue had a negative 1.5% growth from 2010 to 2019. In that same 10-year period, net income grew a little better at 2.2%. Still, that's very low, but of course, McDonald's is a huge company. So the slow net income and negative revenue is kind of expected for such large companies. S&P credit rating is pretty good at BBB plus, and operating income from that 10-year period has only been 1.9% annual growth. However, earnings grew at a better rate in that 10-year period at 6.1%. In the past 5 years, earnings has been growing at 12%. So that's real good. And net income in the past 5 years has been growing 7%. So they've been turning around the growth, the net income, and the earnings. However, revenue has decreased negative 4.6% in the past 5 years. So that's something to consider here. We continue with the fundamentals. For 2019, the company had adjusted earnings of $7.84. Net margin came in at a decent rate at 28.6. And return on equity is a deficit, and this is because on the balance sheet, there's common stocks in the treasury, so that screws up the book value and the return on equities. So we'll talk about that later. Currently, the company has a dividend yield of 2.59 and a 5-year dividend growth rate of 7.6. Adding up both of these numbers, we get a charter rule of 10, which is kind of right there where it has the criteria. Like a little higher, 11 plus, but 10 is okay. And dividend payout at 2020 expected earnings to be 90%, which is very high actually for a company this size. So this is quite concerning. I don't think it's a problem. The dividend is very safe in my opinion, but this is something to consider here. And they've been growing dividends for 44 consecutive years. The 5-year dividend yield average is only 2.62, so it's right little higher than the current yield at 2.59. So that's a good indication there that it may be overvalued. But we'll go continue. And the most recent dividend increase was 14.9 in September of last year, which is great. That's a nice increase for a company that's been growing dividends for 44 consecutive years. A lot of times when companies grow dividends for that long, they tend to be growing it in 5%, 6% range in recent times. But McDonald's did it by 14.9 last year, so that's great. In the balance sheet, as we see here, the debt to cap is at 117%. Current ratio at 1.9, which is pretty good, and the debt to equity ratio is negative. Again, this is due to that common stock treasury, and the price to book, we can calculate that because of that as well. So the balance sheet, it's pretty, I want to say it's solid, but it's okay, it's good. So let's continue. Future outlook, 2020 earnings are expected to be at $5.55. 2021 at $7.98. Remember, 2019 they had $7.84. So this year is a loss of almost $2.30. So that coronavirus did hit McDonald's. Of course, there's a restaurant, so people weren't. They were still open in the sense that the drive-through was still open, so they were making money that way, but not as much as people that dine in, and they tend to buy more. as the family will go in and sit down and such. And 2021, however, as you can see, analysts expect to recover higher than 2019's earning. CFRA has a projected earning growth of 7%. And my dividend yield return model, I can't calculate this because the return on equity is negative, so I can't really calculate this. And forward PE is 24.9 versus the current PE of 28.2. So right here, the PE is very high. The forward PE is at its 5-year average. I like to see that lower than the 5-year average, but that's a good indicator that may be fairly valued or overvalued. We'll see here in the fast graph. The black line is the monthly closing price. The blue is the orange. The blue line is the normal PE of 21.5, and the orange is a PE of 15. As you can see here, the black line, the monthly closing price, is way above both the normal and the earnings. That's a good indicator here based on fast graph that is overvalued. And as you can see, earnings has been growing quite nicely in the past 3 years. In 2016, it grew 15%, 2017, 16%, 2018, 19%. Last year, it had a negative 1%. It was flat based on 2018's, but this year it has a projected negative 29%. But then in 2021, as you see, 44% growth in earnings. So that's a positive sign here. However, based on that, with the PE at current PE of 28, it looks overvalued based on the normal PE and the earnings PE. So this is a good indicator that it may be overvalued. And you can see the total projected return until 2022, if these earnings were correct, maybe only 1.7%. And most of that will be from the dividends because the capital appreciation or lack of will be negative 2.9%. So this is a good indicator here that it may be overvalued. So let's look at our fair value price section here. CFRA has a fair price of $140.14, Morningstar at 205, Fastgraph at 158, Yahoo at 202, and my dividend discount model analysis at $100.39. For the dividend discount model analysis, I was pretty conservative here. I used about 7% for the next 3 years and 6% after that with a discount rate of 10%. So averaging out the 5, we get a fair price of $169 and 19 cents. And currently the company goes for basically $200. So this means that the company is overvalued by 15.1% at current prices. So with that, my recommendation for McDonald's is a hold.
So as you just saw, I have a hold recommendation for McDonald's. I like everything about the company, the 44 years of dividend increase. The most recent dividend increase was 14%. Earnings this year is expected to be less than last year's, but it's expected to pick up. And I see that happening, of course, as things open up and people start to get more confidence in going back into the restaurants and eating in. The few things I don't like is the revenue and net income growth. Revenue has negative growth over the past 10 years and the past 5 years, so that's something to consider. And the most important thing that I really don't like about the company is the high valuation. The PE ratio of 24 is too high for this company. I would like to see it in a PE of 17 or 16 to even consider it as a good buy. So as you saw, it's overvalued by 15%. So a price range around 140, I think is a reasonable price to purchase shares of the company. Just not at this price. I own shares of McDonald's. I'm currently holding on to it and using the dividends to reinvest in other companies that I find to be undervalued. But I do own shares of McDonald's and I would love to own more shares, just not at this price. So again, if you is the first time here, make sure to subscribe to the channel for tomorrow's Dividend Aristocrat. We'll discuss the next company tomorrow's. So I'll see you guys tomorrow and have a great one.